1, 2.
Hey, good morning, Sean. How are you?
I'm doing pretty good.
Well, that's good to hear. I know offline you talked about your braving the humidity. What's going on out there?
Oh my God. Yeah, well, this area has intensely high heat naturally. Probably one of the hottest spots in the country. So, and it's normally not humid. And I lived in Illinois, and I can attest that a 95-degree day in Illinois is much hotter than 105 or 110-degree day here. Now, when it gets up to about 118, 119, 121 here, that starts being a whole different that starts being a whole different scale, because it's kind of an exponential effect, But what happens is we do have a rainy season. And the rainy season is literally during the hottest time of the year. So we don't get 90% humidity, but when it jumps from 15% to 45 or 50%, it feels like we have 95% humidity. So it's just crazy. It's just crazy how how humid it gets and what an effect it is. So I jokingly say I have to go brave the humidity, even in the mornings when it's relatively cool. When it's humid, it just is very sticky. It's not a whole lot of fun, but it only lasts for about 6 weeks, if even that long.
Yeah, well, that's a lot shorter than Chicago winter, so I can't say that I have too much sympathy.
No, and I've been through Illinois, northern Illinois winters, and I'd much rather take oppressive, nasty summer weather than those winters again. A $2 billion hedge fund that I returned 80% would maybe get me back to Chicago, but that's a maybe. Because sometimes money, it really is that simple.
It looks like we're having a few technical problems hearing you on our end. Can you hear me okay?
I can. Let me check something. I had to walk and go grab something. Is it better now?
So far it looks like, but it does look like it's
testing.
Yeah, can you hear me? It looks like it might be
great.
Okay. It looks like it might be fading from your end. So not trying to create blame here, but
no, it's okay. I think it should be okay now. I had to go switch a headset.
Okay.
Because my battery was going on the other one, so I switched to headset. So my guess is it should clear up now.
Okay. Well, let's hope it does and move on. We'll apologize in advance if you hear a little bit of a sketchy thing. So don't bombard us. I'm trying to keep track of the problem. So anyway, why don't we dive into...
By the way, if you do, we have had a situation one or two times where just sometimes you just call back and it works. So if you have an issue, just hang up and call me back.
For sure.
Sometimes that just... Yeah, it's just the way internet works sometimes.
Yeah, that pesky internet. All right. So how about breaking down this Broadcom CA deal? What's your thoughts and were you surprised by it?
Well, a little bit, but I'm not. If you just kind of look at what's happening, I mean, you look at the stock is being demolished, right? Mm-hmm. And again, so I've talked about like the market right now. So so maybe people will blame the deal for the fall in the stock price, but I disagree with that. I just say the fall in the stock price was a precondition that was already set up from a stock price that was unsustainably high. And so what happens is it just doesn't take much. Any kind of news that isn't perfect results in a much lower stock price. By the way, I will say, specifically talking about the deal, I don't think it's an overpay. And, questioning the ability of AVGO to be able to get a deal to work is sort of a bad premise long term, because I've even said this. I mean, give credit where credit's due. I have said these guys are probably the best. They have been the best M&A buyer of any semiconductor company I can think of for at least two or three decades by far. A close second might be Skyworks. But AVGO used to be a $30 stock spun out of Hewlett Packard. right? And they had very nice businesses, but they were like kind of leadership niche businesses, and they merged their way into literally a globally dominant semiconductor company. And it's frankly been an amazing feat. And it wasn't like when they got spun out of Hewlett Packard, it wasn't like they got spun out with like a massive amount of cash. I mean, they've pretty much done it by themselves. So, I mean, they've done a good job. This one, but what happens to sometimes companies become a victim of their own success. Honestly, I mean, hey, if I'm a big tech company and I'm out there and I'm looking for cash flow plays, I'm looking for things that are decent buys on a valuation basis, and I don't think I'd buy CA. But hey, that's just me. The one thing I can say is they didn't overpay for it. But it's hard to overpay for CA because it's such a slow growing, kind of muted valuation. It's just kind of a slow mover plotter. So I mean, this is a cash flow play. I mean, they're basically buying a cash flow generator, and they're probably going to be able to lean it out really good, and then milk the cash flow. I'm not exactly sure what they'll really do with the technology, but they probably have some good ideas about it. So I mean, long term, they'll probably be able to make this deal pay dividends. But short term, it puts pressure on a stock that just probably shouldn't have ever traded where it traded to. And so I think that's the effect we're seeing today. All
right. Well, then, with that said, where do you see fair value for AVGO if you're not looking to take advantage of a dip in this one?
What did I calculate it at before? I mean, something to where it got cut in half from that 260 to 270 level, I think would be much more reasonable. I mean, I was looking at buying that stock a couple years ago at 100 to 120 without much of a problem, and then they've grown kind of a little bit since then. So yeah, I mean, you have to kind of see what the next couple quarters look like. At the same time, I don't know if there was a reason I didn't buy it a couple years ago at the prices then, and like you say, well, wait, it kind of went 2x or 2.2x. Well, I mean, there's other stuff I bought that went 3 or 4 or 8x. So as good of a value as I thought kind of AVGO was, and let's just call it 120-ish, I found better values. So, even at 120-ish, where I thought it was a good value, I didn't think it was I didn't think it was a great value. It was a very nice name, nice chip name, but I mean, you basically could have got effectively the same return by buying Apple back then, which is kind of what I did. And then, like I said, there's some other things that work way better. The more speculative small cap tech in early 2016 was so crazily undervalued. Whereas the mega cap tech had taken a hit back then, but it wasn't nearly as as victimized. But yeah, no, I mean, for people that like this kind of name, big safe kind of semiconductor stocks, I mean, it's kind of getting around there. I mean, put it this way: people are downgraded it now, and people are not now. They're not going to be as excited about it now, but it's a way better buy at 200 than it was at 270. But I'm not really interested here. Like say, 135, 150, I might be. But even at that price, I think I'd still much rather own Qualcomm or Sina or again any number of things that I own. But it starts getting interesting for a trade. Like you take another 20, 30, 40 points out of this thing, and you really get a kind of a short term kind of what I call a pessimistic flush. Mm-hmm. You could get a pretty nice trade. So I'd look for that maybe as a first thing.
All right. So moving on to some of the other names that you have been peeking at, we got a listener question about FireEye. What's your thoughts on that one now?
I actually, FireEye I like a lot. It's a plotter. In fact, it's much more of a plotter than really I thought it would be given the last 2, 3, 4 quarters of quarterly performance that they put out. But we talked about this. There's a very good reason why the stock hasn't acted well recently, and it's because a lot of money. If you like security stocks, there's been any number of security IPOs that have all the sexiness that you can desire to fire at, and they've worked. I mean, ZS worked very well. I recently bought some Carbon Black. It's up another 2 points today. I think I'm up like 4 points on this in 3 or 4 trading days. So that's a name I do like. I think that's one of the better valued names of newer IPOs. But there's been a lot of sexy come out in the IPO market, and I just think that there hasn't been a big reason for people to feel like, hey, I need to buy FireEye right now. Which, by the way, I always talk about that. If you're always trying to, if you focus more on the time frame of when you're going to make money versus what you're going to make money on, you'll do far worse. Most people will. So if you just buy the really good buys and they kind of let them work when they are meant to work, you can make exceedingly huge amounts of money. And so I kind of think that's how FireEye sets up right now. I think it's a very good buy. It will work when it's going to work, which could be relatively soon. But it is kind of one of these mysteries. It's sort of like I want to say 2 or 3 quarters ago, where I thought Twitter had a really good quarter. I think it was the last time they sold Twitter off into the high teens or low 20s. And, they just picked it apart, picked some really stupid things apart. It was really the last big sell-off to get really great buys on Twitter. And it's entirely possible. I don't know. We never know this until after the fact. But it's entirely possible that FireEye is kind of in that phase. Like, that a year from now or 18 months from now, we could be looking at a $30 or $40 or $50 stock. 50 is probably a stretch, but you never know. But and then we talk about the time where, wasn't it weird how for 6, 8, 9 months it just didn't do anything, even though the company's performance was actually improving and quite good. It just was, algorithmic disinterest at the time, which created a valuation vortex, which is I kind of think what's going on. So what I will say is FireEye is at the point where if they deliver another nice quarter or another 2 nice quarters and there's any higher upside surprise, you could get an accelerated move. Again, very similar to that Twitter move from what was it, 22 to basically 38. Or the CyberArk move. That's the other thing. CyberArk acted just like FireEye did. They arguably never really had a bad quarter in the company's history. They just have had quarters that weren't great. They've had good quarters and they've had great quarters. And early on, they had a lot of great quarters. And then they went into a cycle where they just had really good quarters, but they weren't great quarters. And the stock just didn't do anything. It was kind of heavily victimized for, the better part of a year or two. And look at that. Very, very nice quiet. We're talking not quite a double. 40 to 67. Well in excess of a 50% move. And by the way, they haven't reported spectacularly. It's just people have kind of gotten used to the fact that, okay, maybe really good quarters or really solidly good quarters are good enough for a stock that's trading too cheap relative to its peers. So I think eventually the same, as long as FireEye doesn't have a bad miss, I think kind of the same move that we've seen out of at CyberArk will happen to FireEye.
All right, so let's take a step back from and touch on our last conversation, and that was about a week ago, and you thought that one of the prime scenarios that you would be looking for would be, back at that time, if you recall, an increase in a rise in the NASDAQ, accelerated rise coming out of the Friday jobs report. We got exactly that, and you had mentioned that you would be potentially looking to short that type of pop. Now, I didn't circle back to see if you actually did that, but since I have you on the line, why don't I ask you about that, and what do you think of the NASDAQ now since we got another pop?
Yeah, no, in fact, I think I did increase some short-term trading shorts, which I think they worked for about a half a day or something. I haven't really increased my short book permanently, meaning I have on a net basis, I haven't really increased my overnight or over week position. I have added some shorts for trades. I'm kind of looking around. But I really haven't. I put it this way: I just haven't seen that downside move stick. I think it could happen relatively soon. Again, I would basically say we're kind of hours to days away from this thing rolling over again. Here's what it feels like to me. It almost feels like we're kind of running into the Netflix print. The Netflix print is it's either next Monday or next Tuesday.
It's Monday.
I think it's Monday.
Yeah.
So yeah, it just kind of feels like one of these setups where we things get overly juiced, and you run into a wall basically, and so the bar gets moved higher and higher and higher. And I don't know that you don't want to try. Again, I don't try to be overly precise in timing, but it's possible that we kind of run in and go in, and then is the Netflix report kind of, no matter what it is, kind of a marker, what I call a marker to sell stocks. So we'll see. That's my guess right now. But I'm certainly maintaining shorts, and I'm kind of nibbling at some increases. Again, the typical names are NEWR, IGV. I think I did post a Netflix short. Maybe not. I am trying some Netflix put spreads. So I don't know. We'll see. We'll see what happens. I as you can kind of tell just from my voice, I'm close, but I'm still kind of undecisive. Because what I like to see, I make a call, but then I want to see some confirmation on the call. So, for example, hey, I made a call on TRVG. TRVG is confirming my call. My short call, put it this way, everything is like kind of running in place. We go up 2 days, we go down 2 days. Sentiment gets hot, then it kind of drops. But we don't reach a finality or a turning point or a crossroads. We're just sort of like, it kind of feels to me like a lot of these highly valued stocks are kind of running on a treadmill. Because, people get excited the fact that they're bouncing, but it's not like they're really making a ton of headway higher. And yet, the charts just keep getting more extended, even though the long-term kind of view is that they're starting more to go sideways than up now. So, that's kind of a classic setup, right? Usually before, everybody always thinks it's like Mount Everest. You go up and up and up, and then you crash. That's usually downturns don't occur that way. They can sometimes, but the typical one is kind of like a AVGO. In fact, if you pull up a AVGO's chart, there have been signs of that stock weakening for basically 2 quarters, and so that's kind of what I'm looking for. That's kind of what I'm waiting for with all this stuff. And look at AVGO today. You get a kind of a news story out of nowhere, and boom! The thing's collapsing. So, and I've talked about this as a favorable short for, again, the better part of 2-3 quarters. Unfortunately, is one I didn't do, but I have recommended this as a short, and this is one that has worked pretty well. But that's another reason why I kind of keep harping. I'm going to keep harping on this IGV. The thing I like about the IGV the most is the same thing. When I'm down on it, okay, I'm down, 8, 9, 10 points. Well, on $185 basis, that's not devastating. And again, it has been showing signs of kind of wanting to roll over. And again, I'm talking more technicals right now because the fundamental picture, in my view, has already been put in place. Each quarter that goes by, you got to get better and better and better results to fundamentally justify the moves in the stocks. So to me, it's just a matter of time. Again, you're basically waiting for technical confirmation on a lot of this stuff. And honestly, just haven't really seen it. It looks like it's setting up, and then what happens is the technical confirmation basically fails. So I will definitely get more interested in increasing size when I get positive confirmation instead of no confirmation.
Okay. As far as your sentiment readings that you highlight a lot of times about the NASDAQ, where are we on that?
Well, we got very, very hot. In fact, I was just the next note I'm going to have is going to kind of talk about the setup. We got very hot. Again, we've had these sharp down days. So what happens is we have 1 or 2 sharp down days that cools it, but then they don't. Again, they don't continue. We get 1 or 2 down days, and then we kind of right back where we are. Mm-hmm. So sentiment is almost kind of like it's kind of holding at high levels, but we haven't gotten to like what I call a shockingly what I call a no-brainer crazy spike level. So it's almost like the the pressure gets let off the steam valve right before it becomes a really succulent trade. You know what I mean?
Mm-hmm.
But there's some interesting dynamics. Things so individual things I follow, like the put call, like the fear is starting to rise on the put call numbers. Yet stock prices haven't really gone down much, and the VIX hasn't increased. So there's some interesting things going on, but I mean, the best way to say it is sentiment is definitely elevated enough that we could get a drop, but it doesn't hold a spike very long. So we'll just have to kind of see what happens. It's like a lot of these charts. It's probably the best way to say it is it's extended, but it's not acting like Mount Everest. It's starting to go sideways. And by the way, that's a lot of times that's a precursor of how it looks before it fulfills lower. Meaning, you finally get selling in stocks, and then they try to hold it up for a while. Then all the dip buyers get discouraged, and you get a cycle again. You go from a greed cycle to a fear cycle. And again, we all know you get the absolute best buys when fear peaks, just like you get the best sells when optimism peaks. So you could argue we could be in a phase for stocks where maybe optimism sort of peaked, and now it's holding at a high level, but it's not really going up anymore. It's just kind of trending sideways. And there have been a lot of times in history that's happened, and like I say, that's kind of what happened in 2015, which preceded a pretty big drop. It's exactly what happened in 2014, which preceded at least a big drop in a couple subsectors. So we just have to see what happens, but sentiment is definitely high enough that you could put it this way: it hasn't dropped much at all to go into a point where it's a good buy. Put it that way.
Okay, so you had already mentioned this one a little bit, and one of the listeners is asking the question as well, and that is in regard to NEWR, ticker NEWR. I know you call it NEWR, it's New Relic, but asking if you're enticed to short anymore around these levels.
Well, I am, because this is around the price. I hit it pretty good one time, and I think it went all the way down to recently. In fact, I think it kissed 96, 95, 97. So it's having a pretty good pop. I mean, they're all kind of acting the same way, whether it's Adobe, IGV, NEWR, Okta, what's another, Twilio, former flame of mine, Twilio, Nutanix, they all kind of act the same way. So, and by the way, I don't really see a big reason why they're up. I mean, if they're up because AVGO just bought CA, that's not a very good reason for them to be up. So anyway, we'll just have to see. But yeah, no. In fact, New Relic is kind of front and center as something. And I have increased this a couple times. I could easily do it again. So we'll see what happens. I post it when I post it. But what I'd really love is is kind of a flash move above the old high that basically fails. And we're pretty close to testing the only 3 points, less than 3 points maybe away from the old high. So there's a lot of interesting setups. I mean, that's the other thing too. So there's a difference between a setup and forcing a trade. And I'd rather short more New Relic at by the way, 104 or 105 is fine. But if it does burst up through 112 and then fails, that the timeliness of that trade might work quite a bit better. So that's kind of what I'm watching right now. See if it makes a new high, they burst it higher, and then that fails, and then we should get a better low. In fact, I would say the next move would probably be a low that exceeds that $96 low. Which would be pretty juicy. You get a short at 112 to 114 and a move below 96. I'll take that all day long.
Yeah, for sure. All right, so that addresses that question. There's another one regarding TRVG, and the listener wants me to ask if you have any issue buying TRVG pre-EPS. You're already long it, I presume, right?
Yeah. So if I'm long something and I haven't, I mean, I don't.
Well, let's pretend you're not.
Worry. Okay. Well. I'll answer it both ways. If I'm long something then effectively that means I would buy it pre-EPS. I'm not going to sell something because of an earnings report. If I am going to sell something because of an earnings report, I'm going to say, like, I closed AAOI recently. Not that I'm like extremely worried about the earnings report, but yeah, I milked it. I got my money out of it. I don't necessarily want to risk gains through the earnings report. So that's a great example. So hey, I'm not buying AOI in front of the earnings report. But if I own something and am willing to own it through the report, that also means if I didn't have it, I would be willing to buy it. Because if I'm of that school. If I own it, it's like I'm willing to buy it today at the same price. Otherwise, I wouldn't own it. So if I wouldn't buy a stock at current prices, I probably wouldn't own it at current prices.
Okay, so I think that clears that one up.
Yeah. By the way, I will point out this thing kind of teased my buy stop level today. It didn't hold it. I have a buy stop I posted. I think it was yesterday.
Trivago?
I think the set. Yeah, I think the sets up as a nice buy stop. At 490 and higher. So now, ideally, I'd like to see a close above 490. Doesn't mean I won't execute one intraday, but it's doing exactly what I want it to do. And this is just somebody. I have another question. I'll address it because that person might not be listening right now. But they said talk about the fundamentals. The first thing I'd say, make sure you go back and type in the symbol and read what I've said, because if I generally talk about fundamentals far more than I talk about technicals, and generally I also talk about fundamentals before I talk about technicals. So I've kind of made a fundamental case for this already, but just to reiterate, I mean, just as an example, this trades at basically 1/4 the valuation of TripAdvisor, and TripAdvisor isn't exactly a sexily valued name. It's not, it's in fact I think TripAdvisor is a relatively decent value. I kind of missed that trade. I think I've owned it once on the site, and then the last time it set up, I didn't buy it, and I was looking at it. I want to say I was looking at it almost, if it wasn't 20 points lower, it was like 15 to 18 points lower than here. So TripAdvisor meets my valuation criteria. I would be comfortable buying TripAdvisor at the levels it's valued at on various metrics. And just as an example, Trivago trades at roughly 1/4 of the valuation of TripAdvisor. That's how cheap it is. And that's what happens to these stocks that get into these severe, what I call these algorithmic downtrends. They kind of go to levels that don't make any sense, but they make sense to the people that watch them because people believe in recency bias. And a lot of people believe that what a stock's trading at is what it's worth. I don't believe that at all. I don't believe in market efficiency. I think markets are highly inefficient, in fact, and it's proven all the time. But the bottom line is, these things get these algorithmic persistence trends, and they end up going far, far below where they should go, just like they end up going far, far above. And so, fair value, I could make a case Trivago probably should never ever traded much below, let's say, 8 or 9, because at 8 or 9, it's trading at a 50% discount to TripAdvisor, which is already a relatively cheap stock in its own right. So this is just sort of how crazy stocks get now. They get extremely overvalued and they get extremely undervalued, and Trivago's in the extremely undervalued camp, which is why I love having shorts that are extremely overvalued, and I love pairing longs. Not all my longs are this way, by the way, but I love pairing longs against those types of shorts, and over time it tends to work pretty well.
All right. So
by the way, Groupon is similarly stupidly cheap too. It's very similar kind of. It's almost exactly the same valuation metric, by the way, as Trivago. Just if anybody's curious, it basically trades at a 1/4 of the valuation of TripAdvisor, i.e., a 75% discount to TripAdvisor. And again, TripAdvisor is not an expensive name. So I mean, what would the discount be to something like? Another name that is valued at 4x what TripAdvisor is that like a 98% discount? I mean, the numbers get so extreme they're hard to make sense of. But when I was pounding the table on Twitter, I was saying it was like 88 to a 90% discount to peers, and what's happened? It's that discount has been largely rectified at this point. It hasn't been completely rectified by any stretch, by the way, but it's been largely rectified. And so, you know, the only thing these companies can't do is they can't keep disappointing. So other people would say, well, you know, their results have been so bad, that's why they traded the discount. Well, that's not really true, because, you know, a company is not solely valued on pennies of EPS, whether they miss or not. You know, there's a lot of ways to value companies, and the ultimate arbiter of valuation is cash flow. So these things are very cheap, but that doesn't mean they're going to work right away. I mean, that's the one thing you have to remember, is that these work when they work. We can't force them to work just because we want them to work in 3 weeks.
Yeah, unfortunately, it doesn't work like that as much as we want it to. Before we jump off of Trivago, the same listener has a follow-up question and asks if you have any particular feel about the current quarter for Trivago.
You know, I really don't, because on something like this, I honestly don't really worry about the quarter, because when I get these sorts of crazily extreme valuation discounts, I kind of go into a mode where I don't really care, because the quarters probably have been kind of rough already. But again, what happens is stocks overshoot the bad news. So the bad news, sure, maybe the bad news has been pretty bad, but it ain't nearly as bad as a 75% discount to a cheap stock. So, you know, things just get extreme. But I will say this, I mean, you know, the longer that, you know, what happens is you get a cycle. And so the cycle becomes, and by the way, you've seen me call the cycle very accurately a few times. I'm not saying I'm doing this on Trivago right now, because I'm not, but my short on AOI, I very, very accurately called the optimism cycle as well as the peak earnings on that. Then I very accurately called a turn on off the bottom, and I've done that with quite a few stocks, by the way. Trivago is a little tougher because you're melding a lot of different things create their quarter. You know, you got tourism, you got travel, you got consumer spending, discretionary spending, global economic conditions, U.S. economic conditions. You get the point, right? It's not as clean. Micron, probably one. That's a stock I can accurately call their earnings almost every single cycle, because there's identifiable things I can point to which give me very good clues to where Micron is in their cycle. TripAdvisor, something that's dependent on the emotional spending decisions of people, is much harder to call. But I will say this: we could be getting pretty close to. Analysts tend to get to a point where at the very end of a cycle, they way overshoot the pessimism of their estimates. Likewise, same. It's the opposite when when they're too optimistic for too long, they overshoot estimates to the upside. So we could be getting pretty close to where analyst estimates finally are getting way too low on Trivago, and so the odds of them missing become less and less and less. And then you know what happens when a company doesn't miss. Well, they either meet or beat. And if they beat, then they start acting better. By the way, even if the beat is totally stupid and immaterial and doesn't really matter, it gets to a point where you get easy comps. And, you know, stocks can move ridiculously well on very small earnings beats, especially if the expectations are for a beat to not occur. So yeah, we could be, you know, so that's the only thing I could really say is we could be getting pretty close to a point where there's an analyst overshoot of pessimism on their Trivago's numbers.
Okay.
And that's a beautiful place to be. If that occurs, that's a beautiful place to be. That's effectively what happened on Twitter, by the way. So, you know, analyst overshoot, got too pessimistic, kept assuming the recency bias was going to hold. Oh, what happened? All of a sudden, Twitter started doing better, and far better than analyst expectations. And then the cycle begins. So then analysts raise numbers, but they don't raise them enough. Twitter beats again. Analysts raise numbers again. They don't raise them enough. They're still overly pessimistic. Twitter beats them by way more, and so on and so forth, right?
Mm-hmm. All right, now let's go back to Groupon. And I know this listener has asked this question earlier this week, probably. There was apparently a Recode article suggesting Groupon was putting itself up for sale. Have you had a chance to look at that, or do you have any take on that? So we're looking at Groupon.
Not really. I mean, I use Briefing, right? So I've read all the news that Briefing's posted about it.
We did have a link to that, just for your
Yeah, yeah.
FYI.
Yeah, so I looked at, I don't think I read the whole article. I just looked at the whatever briefing said, because here's my view. This again, remember when Twitter was supposed to be bought for $25 a share? Was it? Nope. Did I say Twitter was going to be bought? Nope. Did I say Twitter would not sell themselves at a fire sale price? Yes, I did. So it's kind of the same deal. I don't think Groupon's going to sell themselves for a fire sale price. By the way, sometimes smart companies will explore things like this because it stabilizes things. It might show that there's more value to an undervalued asset, right? Mm-hmm. And companies don't want their stocks to go into an endless death spiral and never improve. So, corporate management's one of their objectives is to increase shareholder value. Well, shareholder value is tied to the stock price. So they will do lots of different things to highlight value of a company to improve the stock price. This is one way to do it. And I'd point out, when did Twitter quit hitting lower lows? It never hit another lower low after there was a potential buyout of Twitter. Wasn't that interesting, right? Because all of a sudden, you at least had a floor, had a marker. Okay, somebody was CRM. I think they would have gladly bought Twitter for 20. They might have even been willing to pay $35 for Twitter back then, but they, nobody was probably willing to sell it at that price. So we'll never know the exact story. The published story was that Twitter wanted 40 and CRM was willing to pay 26 or something, right? Well, I don't buy that for a second. I think the people at Twitter had no interest in selling the Twitter and because they knew things were coming, things were improving. So this could be just one of these things that kind of sets a marker and just improves the trading of the stock for a while. But I would be pretty surprised if Groupon is hey, everything is available for sale at the right price. If somebody wanted, they might be shopping themselves and they might think they're worth 4x what the company is currently trading. But odds are nobody's willing to pay that. But yeah, theoretically, are they willing to sell themselves for the right price? Sure. I think every company is.
Then what's your valuation?
I think if things got good and they close this massive valuation gap, you can make a case for 15 to 20. But right now, I always say, look, give me 650 to 8 before I go to 20. You know what I mean? Mm-hmm. Right now, I'd be pretty happy with 650 to 8. If it shows that it can trade between 7 and 8 for an extended period of time, then what does that tell me? It tells me that sentiment has changed. Maybe Groupon's not going to trade at such a distressed valuation. Maybe it's going to trade more in line with fundamental valuation criteria in the group, and then I can start kind of again closing that discount gap. Right? There's definitely an art to that. But yeah, if I had to put a kind of a midpoint on my price target right now, I'd probably say it's excess double digits though. It's probably sort of in that 10, 11, 12 area. Is probably where I'd sort of say, well, just to do the easy math. So if it's a 75% discount, or it's trading 1/4 of what a TripAdvisor is, well, guess what? If it trades 1/2 a TripAdvisor, that means it would have to double. So and so it would still, if Groupon doubled, it would still trade at a 50% discount to TripAdvisor. So that still leaves plenty of room higher. But that's why I say, give me 650, 7, 8 first. If it proves to me it can trade at 8, then I'll say, okay, well, maybe it's going to close the valuation discount further. If it fully closed the valuation discount, it would be a 3-bagger. So it'd be 3x what it currently trades at. And again, that doesn't mean it would be an expensive stock. It would just trade in line with something like a TripAdvisor, which is relatively modestly valued company. But 650 to 8 is kind of what I'm projecting in a reasonable time frame. And again, remember, and this, as companies have to overcome a ton of pessimism, right? Mm-hmm. That takes a while. Pessimism can't turn on it just can't. It can't turn on a dime. A big buyer like a Fidelity Magellan can't buy a full position in Groupon. Well, maybe in Groupon they could, but in a typical stock, it takes weeks, if not months, for companies to reposition their books and things like that. That's why these things all take time. But I think that, but see, like you could get a fast double. if something good were to really happen, you could get a fast double, just like I said on Pandora. By the way, Pandora is kind of the closest, the most proximate thing to Groupon and Trivago would be, okay, Pandora. Go back to what I wrote about it a while ago when it was $4.50 or $5, and I said I like Pandora. Okay, Spotify came out, massive valuation, huge valuation discrepancy, massive discount. Well, nobody's even excited about it. I think I put this in my note yesterday. I mean, Pandora's doubled, and there's almost zero commentary on it. so the stock probably isn't even close to topping out until there's quite a bit of excitement around it and around the stock move. And I can't recall the last time I saw anybody on any media site or on TV or anything say anything positive about Pandora. So until that happens, it's probably got quite a bit of upside. So the Groupon, Trivago, these things, they get these pessimism cycles. And as the pessimism cycle unwinds, you can have quite a bit of upside. All that said, these are penny stocks. I'm never going to put that much of my capital in a penny stock. I don't care how much I like it. So that's everybody's own personal risk decision. I'm only going to buy like whatever dollar amount I feel comfortable owning a Qualcomm in, for example. At most, I could put like a quarter of that dollar amount in something like a Groupon. And by the way, I think that's a good way to do it because guess what? If I hit it and it does double or triple, I don't need nearly as much dollar amount to make quite a bit of money in it. Right. Right. Mm-hmm. So it's the same thing. These lower price stocks, I always have a dose of. I mean, put it this way, I'm going to be somewhat skeptical about them too until they prove it.
All right. And the same listener who asked about Groupon asked about your thoughts. Let me get this question lined up for you. Bear with me.
Well, by the way, while you're looking at that, no, it's all right. By the way, while you're looking for that, okay. I would say something like a FNSR right now. I still like far more than Groupon and Trivago and Pandora and things like that. Just because I can really anchor a valuation move and a fundamental catalyst and all those other things. I don't really have to bank on a valuation and revaluation sentiment cycle. I just have to bank on FNSR delivering and doing what cyclical companies tend to do, right? So, and then we're talking about a global niche industry / leader company for 20 plus years. So I have quite a bit of faith in a company like that, and that's a relatively cheap stock too. But I mean, so in other words, that's a good example of something I can have more faith and put more capital in than these real low price stocks.
All right, I do have that question now, and wants me to get your opinion on Nokia and its recent 5G wins.
Yeah, in fact, I saw that. Somebody sent me that question. I don't even know. I do try to answer almost every reader question if I can talk to it. This is one where I don't know what I would really say other than because I don't want to call it a piece of garbage. You know what I mean?
Yeah.
But it's. I mean, is Lucent still around, or was it bought by somebody?
I think Nokia might have bought them.
Maybe either Nokia or Ericsson bought it. So here's the problem. The problem with Ericsson, Nokia, the former Lucent, the former Nortel went bankrupt. So that's not a fair comparison. But sometimes companies just don't have good technology anymore. So I tend to migrate to the best technology over time because if you hold on to outmoded technologies, this is where valuation. This is where you have. And what I always talk about TAM. I mean, I still much favor TAM and growth over valuation. I love cheaply valued stocks for trades and investments for part of my book, but I'm going to favor a growth re-energizing story of something like a Twitter, or I mean, again, what companies were on my focus list forever: Splunk and Nutanix and Twilio, and I've recently taken a couple of those off. But I like growth stocks. I like companies that have leading technology. I like companies, in fact, that their technology is setting the standard for the world. I don't think Ericsson and Nokia have had technology that has set the standard for the world in 15 or 20 or 30 years. So honestly, I almost don't even follow companies like that anymore, because all you can really hope to do is catch an end of cycle makeup trade. And what I mean by that is sometimes these old school tech companies, there's just nothing left to buy. The market gets expensive. They've taken Now up as much as they can. That's NOW. They've taken Workday up as much as they can. They've taken Splunk up as much as they can. Every FANG. There's nothing left to buy. And so sometimes you get a big reflex move out of old companies that, hey, they have cash flow, they employ people, they sell products, but they're not setting the global standard for technology innovation anymore. Google is still doing that. Apple's still doing that. Microsoft's in the mix of technology innovation. They do a very good job of buying the innovation they need to stay near the leadership position. Same with Oracle. Oracle's very good at, if they don't have the technology in-house developing, they go buy it. So yeah, the only thing I can say is, well, these guys could be good case studies in what they should have done over the last 20 years to not put themselves in the position they're in. So I like I said, there may be a good fundamental reason. Nokia might have some interesting technology they're working on. Ericsson might have some interesting technology, maybe some interesting 5G technology. It put it this way: if they have it, I'm not an expert in it. I don't really even follow these companies much anymore. So I will answer the question sort of in the note as well when I follow up. But you know me. Hey, if I don't feel I know something, I just don't really say much about it. So all I really know about these companies, they're old guard, kind of cheap, very cheaply valued companies. But now that might be they might be valued there for a reason. So if companies don't have big TAMs, and they don't have big growth, they don't have leading. That's the one thing about technology. You have to be the greatest risk is technological obsolescence. And so if you're investing in a stock and it's just a bunch of products with declining market share because of obsolescence, you're never going to make any money in that stuff.
All right, so no interest in Nokia, and I did look it up. Alcatel-Lucent was acquired by Nokia.
Ericsson?
No,
Nokia.
by Nokia.
Okay.
Yeah, I don't know why.
Well, there you go.
Yeah, random things will stick out in my brain. I wasn't even sure on that, but just for some reason I seem to remember it. All right, so. But
see, this is a question I love because like. And again, I'm not harping on FNSR. It just happens to be in the front of my sort of my cortex right now, right? But what do they have going? They have 3D sensing. They have a big Apple investment. They're going to be delivering 3D sensing technology into the global leader in for the handhelds in that, as well as the proliferation of that technology into whatever it ends up going into, automotive, gaming, and whatever else they can dream of. VR, AR, again, you name it. And that's the big growth piece of their business. So my point is, the other biggest problem, so I always look at everything in a huge matrix. So if I like something, I don't just like it on its own merits. I like it, and I'm evaluating it versus 40 or 50 or 400 other candidates. So I just don't know like what Nokia would have to show me to supplant its position with 400 other companies I follow. You know what I mean? So that's probably the best way to say it, is that I just can find. I can find 10 or 20 or 40 or maybe 300 other companies I'd rather buy. I mean, honestly, I'd rather buy Splunk. Even though I think Splunk is overvalued now and could be at risk of a 20 or 30% decline. I very much believe Splunk will trade a much higher price in 2 or 3 or 5 or 10 years. So, I mean, again, not to beat the horse here, but I really think if people think like that, if they think, okay, I'm not making a decision on this discrete company, what are other things I'd rather buy or sell than this? Then I think it really helps sharpen your focus and increases your odds of success, put it that way.
Okay, so probably our last listener question revolves around SIRI, ticker SRI or SIRI, and because we were talking about Pandora and I don't think you mentioned Spotify, maybe you did, but do you have a take on SIRI? Okay.
You know, I don't, because it's almost kind of the same thing. I used to follow this company more. At one point, it was very interesting from sort of a potential M&A perspective, and I kind of think that's what's happened. I believe some companies have taken big investment stakes in this, which I think has propelled. It's highlighted the valuation. And then this is I think when they did that, and that might have been Liberty Media. I think when they did that, you had a very interesting cash flow sort of investment thesis there. So, you know, the stock's probably doubled from when other people sniffed it out and bought it when it was cheap and took the investment stakes. And I don't like it as much as other stuff. But I want to say a few years ago, I did think it was pretty compelling. I didn't do anything, but I wasn't a bit surprised that, again, I think it was Liberty Media. It was whoever, it may have been AICA. But anyway, so somebody or a group of somebody's made some pretty big, smart investments in that. And it looks like it's paid off by and large. But here's my long-term technology issue with them. What's their TAM like in a world where there is Pandora and Spotify and other things that are going to be created? So if I remember right, that's probably the reason I probably didn't do anything on that name. Even though, again, there was a point in time, I think 3-4 years back, that I did like it. But I kind of wonder about their technology competitive position long term.
Yeah, and not to mention, think about this, how more and more people now have access to streaming and unlimited plans, so they would gravitate towards whatever Spotify, their music of choice. I would almost venture to guess that the potential upside for this one would be if one of those type of companies have the capital and want to add that as kind of a niche market for their already encompassing subscribers.
That's right. I mean, the other thing I would say, and again, I've thought about this and looked at this. I actually think SIRI should buy Spotify. SIRI being serious.
I didn't know the financial.
I'm sorry, Pandora.
Yeah, I didn't know the financial positions of each one offhand.
Yeah, no. I said Spotify would not can't be acquired. The market cap's too high. But Pandora. Mm-hmm. I think so how SIRI protects themselves from a technology issue long term is they make sure they buy a slot in the space, right? That's another reason I like Pandora when it was cheaper. And I still like it, by the way, because M&A value could be way higher than it is right now, roughly threefold. I think what it's currently trading at. So I mean, Sirius could buy Pandora, and it wouldn't. I mean, it's probably they'd buy it with 1 to 2 years of cash flow. They also have plenty of. I mean, it's a $32 billion market cap. They got plenty of stock currency. So I kind of think Sirius will probably have to do that in time, because it's hard to develop a platform off the floor. It would be very hard to develop a Pandora, Spotify competing product that gained a lot of. I mean, guess who tried to do that? Apple, and Apple largely has failed competing against Pandora and Spotify. And they had the market to themselves at one point. So, if Apple can't build a competing product, then, it's going to be pretty tough for Sirius to do it. But no, I've looked at this thing 8 ways to Sunday. I give them a lot of credit for surviving and doing as well as they've done to this point. But we'll see what happens. I mean, this is a really interesting space long term. Guess what? There's a lot of data in this space. So these guys kind of have a lot. They know the customers. They know spending habits. There's a lot of monetization in this space that's not currently being exploited. So this is a pretty interesting space. So I think we'll see a lot of interesting technology and interesting stock moves out of this space in the future. But yeah, I've long thought that Sirius, especially since Pandora got really beaten up and cheap. Let's say sub 8, right? Sub $8 the first time. I've always thought, man, this would be such a good strategic buy for Sirius. I'm kind of surprised they haven't bought Pandora, frankly. By the way, if they did, I might be more interested in buying their stock, because that's my greatest concern. My greatest concern is how do they address the technology migration in the space long term. I think they have a hard time developing it themselves. I think they're going to have to buy it from somebody.
All right. Well, I think that's a good place to leave off for now, unless you have another stock that you feel we should know about.
Well, there's just a lot of interesting things happening. I mean, again, there's so many things. I'm so tempted to increase shorts. I think we've talked about that. There's, in fact, I'm going to post some new names. I've kind of found some new names I also like in that regard. If you don't mind, let's talk about Twitter for a minute.
Okay.
I think so. So we had they dropped huge being. I mean, I think almost 10% one day. So let's just talk about the logic. So wasn't it not that long ago that fake accounts and robots and bots were going to be the ruination of Twitter?
Mm-hmm.
Right? So I remember that, because I remember writing that people that are worried about bots on Twitter aren't worried about the right thing, right? That's not the reason the stock went to $12 or $13 or $14 was bots. But it was a big, what's the word for it? Like a crying point, or railing point, or contentious. I'm not thinking of the right phrase. Anyway, it was a big issue that the bears kind of hung their hat on, is that these bots are going to be the ruination of Twitter. So isn't it funny that when Twitter, by the way, Twitter's been deleting fake accounts, bots, abusive accounts for a long time now, and they've been doing quite a bit of it for I'd say probably the better part of the last 2-3 years, by the way. So the story might not even be very accurate. It might almost be that's the amount of accounts they've deleted over X number of months. Who knows, right? So, but I just found it funny that something that, had they done that when the stock, had that story come out when the stock was 18, it probably would have popped the stock $3. And yet, when the stock is 47, it takes 10% out of the stock. Bottom line, it's a good thing. The cleaner the Twitter platform means advertisers have more interest, not less interest in it. So to me, and I've known they've been deleting kind of, let's just call them bad actor accounts for quite a while. That's a positive. That's something that's good. That's not something, a reason the stock should be down. And then I found it also very interesting that I think it was Goldman Sachs, that they upgrade the price target pretty handsomely today. Now, I give some analysts a hard time. This guy's been right. He had a buy on Twitter. Now, he didn't have a $44 price target when it was 15 like I did, but he had a strong buy. He either had a buy or a strong buy on Twitter when he was a teenager, and almost no other analyst did. So, my guess is that the momentum is still continuing at Twitter. And we'll see what happens. I mean, Twitter is still not a loved stock. It's not anointed. It's not. There's not excessive enthusiasm about it yet. It's the analysts have kind of been drugged by their fingernails, kicking and screaming to raise numbers and to upgrade the ratings and to increase price targets. So, that's typically a sign there could be more to come on the upside front. So I kind of like everything I see there. Again, it's hard for me to be as bullish on something 3x higher than where I really, really liked it. But hey, I stick with things. I stick with winners if I see the evidence, and it seems like the evidence is still pretty good for Twitter.
All right. Well, I think that's a good place to leave off then.
You bet, man.
So thank you. As always, we should have this recording up there. Do you ever go back and listen to them?
I haven't. I haven't done it one time.
No.
It's probably more of a function of time. Maybe I should. But no, I've yet to go back and listen to one. I just don't. I don't feel the need. I don't. There's no ego. I don't need to go listen to myself. I don't have a day where I'm having a bad day and I have to go, oh God, let me go listen to myself. It'll make me feel better. So I don't know. It's, hey, we did it. It's there for everybody else. I kind of know what I said, so I don't know what it would do unless I was getting complaints about am I saying too much, or am I doing stupid things with speech patterns and speech habits? We all could probably clean up our public speaking. I probably used to be way cleaner in public speaking years ago because I had to do a lot of presentations for corporate stuff. I've maybe gotten a little lazy about it. Maybe I could take a cue from that. But no, I've never listened to one. Do you ever go back and listen to them?
I do mostly for my daughter's sake. So she's like, "Hey, Daddy, what'd you do at work today?" And I'll pop it on just so, and I'll give her. She gets bored real quick, so it
I was
only
gonna
lasts
say,
about a minute
is
or
it what
two.
you do to put her to sleep? Is that your trick?
Almost, you know. One time, one time, my 10-year-old son goes, "Dad, you got the boringest podcast in the world." So, like, it's not a podcast.
I think you have the most exciting podcast in the world.
Yeah, especially when you're on, right?
Well, no, it's just how can the stock market's the most interesting thing in the world to me. So, you know, other people is not, but I don't find any other endeavor more interesting. I've thought that way for a long time.
No, I really enjoy doing it.
No, by the way, I have gone and listened to other people. So I've never listened to myself. There's plenty of recordings you have of other people that I've listened to, other briefing presenters I've listened to. I don't know if we're going to do it again, by the way, but I like the last time we had a bunch of webinars for a membership drive or something like that. I think I listen to almost every webinar. I love those, especially when they have the charts and everybody's other opinions on charts. There's one guy, I won't name names, but I mean, we know each other, but he's been the NVIDIA bull, and I've been the NVIDIA bear, and he's been right. And it's very interesting how, you know, two people can look at the same chart and literally form totally opposite opinions. So yeah, the bottom line is I literally think I watched or listened to all those webinars. In fact, the last 2 or 3 times where we did a series of webinars, I pretty much watched them all.
All right. Well, we just killed an hour. I'll tell you what, time goes by quickly. I've got a trip that I'm making actually later this afternoon to Detroit, so maybe I'll let my daughter listen to it and she'll fall asleep.
Hey, do it. Have a good drive.
All right. Thanks a lot, Tech T. As always, it's been a pleasure.
Okay, take care.
All right.
Bye.
Thanks.